All right, today we are popping the hood on O'Reilly Automotive's latest earnings report. Now, the numbers tell a really interesting story. A story of record highs, but also some pretty significant headwinds. So let's get into it and see what's really going on with the company's performance. First up, let's talk about the big headline number. O'Reilly finished 2025 with a record-setting total revenue of $17.8 billion. I mean, that's a 6.4% jump over the previous year, which just goes to show how much momentum they had all year long.
And to really put that momentum into perspective, look at this number, 33. For 33 straight years, O'Reilly has grown its comparable store sales. Think about that. This isn't just one good year. It's the continuation of a remarkable, multi-decade winning streak. Just incredible consistency.
So yeah, it was a banner year overall, but that final quarter, that's where the story gets really interesting. Because while the big picture looks fantastic, the details from the last 3 months reveal some pretty complex challenges that lie ahead.
You know, the company's CEO, Brad Beckham, he made it really clear that the team's performance was the engine behind all this success. He specifically pointed to their great customer service and, crucially, having the right parts on the shelves as the key drivers for gaining all that market share.
Okay, this is where it gets fascinating. We've got this mixed result for the fourth quarter. They actually beat what everyone expected on revenue, bringing in $4.41 billion. But, and this is a big but, they slightly missed on earnings per share. This tiny little detail? It's a huge clue about the financial pressures that are brewing right under the surface. To really get what's happening at O'Reilly, you have to understand their two very different customer bases. You've got the professional mechanics on one side and the everyday do-it-yourself folks on the other. And this past quarter, well, they were on completely different roads. So the professional side of the business, we're talking repair shops and service providers, they were absolutely flooring it. Their sales grew over 10% for the second quarter in a row. But on the other side, the DIY consumer was way more cautious, showing only low single-digit growth. This split really suggests that while businesses are spending, the average person might be feeling that financial pinch and putting off repairs that aren't absolutely essential. Right. So even with all that revenue climbing, the company is dealing with some serious financial pressures. This is the why behind that little earnings miss we saw a second ago. You could say the engine is running strong, but the fuel is definitely getting more expensive.
And this is the key question, isn't it? You have to understand the gap here. Revenue is all the money coming in the door. But profit? That's what's left after you pay all the bills. So why isn't all that record-breaking revenue translating directly to the bottom line? Where's the money going?
Well, the company itself pointed to a few things. Their selling, general, and administrative expenses, also known as SG&A, are on the rise. And that's the bucket for all the fundamental costs of doing business, like team healthcare, insurance liabilities, and even legal costs. And every single one of those is getting more expensive.
And here's the real-world impact of those rising costs. All those pressures led to a pretty big drop in free cash flow, which is basically the cash a company has left over after paying for everything it needs to maintain and expand the business. It fell all the way to $1.6 billion for 2025, down from $2 billion the year before. That's a $400 million difference. That's a lot of cash.
So in the face of all these challenges, O'Reilly is not hitting the brakes. Not at all. Instead, they're stepping on the gas and doubling down on their strategy for growth and expansion to keep that momentum going.
For 2026, the company is actually accelerating its physical expansion. The game plan is to open between 225 and 235 net new stores. This is such a clear signal that they believe the long-term demand is strong enough to justify making some really aggressive investments right now.
And this isn't just happening in one place. This expansion is going on all across North America. So we're going to see more of these familiar storefronts popping up across the US, plus a continued push into Mexico and even the early stages of growth up in Canada.
Of course, you can't just build a bunch of stores. You have to be able to supply them. And that's why O'Reilly is also making these huge investments in its distribution network. A new facility just opened in Virginia to serve the Mid-Atlantic states, and another massive one is already planned for Fort Worth, Texas, to support their core markets. So, with all of that in mind, the strong sales, the rising costs, and this ambitious expansion plan, what does the road ahead actually look like? Let's take a peek at the company's official forecast for 2026.
For the year ahead, O'Reilly is projecting more of that steady, continued growth. They expect comparable store sales to increase by 3 to 5% and for total revenue to climb as high as $19 billion. This guidance, to me, shows a ton of confidence that they can keep taking market share even in a pretty cautious economic environment.
And that really brings us to the crucial question for anyone watching this company. O'Reilly has this powerful growth engine and, let's not forget, a 33-year track record of success. But with those rising operational costs acting like a speed bump, the real challenge will be navigating these financial headwinds to keep that incredible winning streak alive. And that wraps up our look under the hood of O'Reilly's latest report.